Friends, very good afternoon. Welcome back to the next session. I am the same resource person from the morning session. Those who didn't recognize me, I just have removed my blazer. For me, post-lunch session, the biggest challenge is to keep you awake. That is my agenda for this session. So if something goes, it's a bonus, validation. But you have been marvelous participants, I'm sure. There's no scope for me to point out and say, Madam, you're sleeping, please wake up. Hope that doesn't happen. Right. A very quick recollection. In today's session, we're trying to learn how to read, how to analyze financial statements. We'll be discussing various models. And as a background, first, we had an orientation for financial statements. What financial statements are, we know. What does financial statements include? How many items are there? 5. Statement of profit and loss, balance sheet, statement of changes in equity, statement of cash flows. Although in annual reports we find financial statements, for analysis, particularly income statement, we have to be represented, re-prepared in a specific format, which we saw in the morning session. Fine. And once we're ready with the financial statements in the required format, we're ready to analyze. I started with a model, DuPont model, but before I get into that, I'll take a small deviation just for you to give one foundation which can help us in a later discussion. So any of you are not yet come to the track, take this as an opportunity to come back to track. Now, I'm just deviating and discussing how to read cash flow statement. And why I'm doing it now, before I complete it, you'll get an idea as I progress further. How to read statement of cash flows, a brief discussion. So quickly, sir, what does statement of cash flow give us? Cash inflows and cash outflows. So to open, so this time I'm opening Bata India Limited. Bata India Limited annual report. The cash flow statement is in page 105. Okay. Sir, all of us know the format of cash flow statement. To just give a basic orientation, it's a statement which gives details of cash flows, and this is the format of cash flows. We take opening balance of cash and cash equivalents, opening balance of cash and cash equivalents. To this, we add or deduct net cash flow from, which are the 3 activities, sir, in cash flow statement? Operating activities, investing activities, and financing activities. Financing activities. Now, when I say net cash flow, what do we understand, sir? Net cash flow, difference between inflows and outflows, which means the net cash flow from operating, investing, financing could be plus or minus. So plus or minus, it could be any of this, the net cash flow. And when we adjust this, we get closing cash balance of cash and cash equivalent. Closing balance of cash and cash equivalents. Right? Now, this is the format in which we prepare or a cash flow statement is presented. Now, before we see how to read, net cash flow means cash inflows, cash outflow difference. Now, quickly, what are the cash inflows from operating activities? From operating activities, what are the inflows? Sales, mainly revenue from operations. How about outflows? Operating expenses, operating cost. So the net cash flow from operating activity is nothing but operating profit or operating loss. In case the operating cash inflows are more than operating cash outflows, it is operating profits. Otherwise, it is operating loss. So that is first item. So in bottom, net cash flow from operating activities, you see a number. Net cash flow, which is nothing but difference between cash inflows and cash outflow. And it is nothing but operating profits. Okay. Now, please think and tell me. When I say investing activities, what does cash outflow involve? Investing in what, sir? Assets, infrastructure, fixed assets, etc. So cash outflow on investing is nothing but investment in assets. Inflows, sale of assets. So the difference between the two is what we show here. If the difference is positive, negative, what does it mean? This year we have invested more in fixed assets. If the difference is positive, there's sale of fixed assets, more. Now, financing activities, what are the cash inflows? Issue of shares, borrowing of loans in the form of bank loan, debentures, etc. Outflows, payment of interest, payment of dividends, everything related to financing, repayment of loans, redemption of shares, buyback of shares, all this comes under this. Now the net is positive. What does it mean? There is more issue of shares or more funds that has come in, either borrowing. Net is negative. What does it mean? Obligations have been met. Now, how to read a cash flow statement? Whatever given, numbers are of no use for us. Net cash flow from operating 2115.84, net cash flow from investing 928.49, financing 3411.37. Numbers are not what we need. What we need is the net positive or negative. Now, assume for a company cash flow statement, net cash flow from operating is plus, this is minus and minus. So let us say for a company, it is plus minus minus. Net cash flow from operating activities is positive, other two are negative. What does it mean, sir? And this is how to read cash flow statement. Simple. Company is making profits from its operations, out of which it is investing in assets and meeting financial obligations. Is it good? Yes. Wonderful. Right scenario. And if this is what we have for a company continuously for a few years, we call such companies are value adding companies. Okay. Now I'll give another scenario. Please tell me. Let's say minus plus. Let's say. What does it mean? Okay, I'll just make it minus plus plus for the time being. Okay, minus plus plus. What does it mean, sir? Company is incurring losses from its operations, which it is making up by selling assets, borrowing funds. Is it good? Worst scenario to happen. Now, you can write stories about companies just by looking at the symbol, the sign of the net cash flow. Now, Bata India Limited, please see. Net cash flow from operating activities, is it positive or negative? Positive. Investing activities, last year it was negative, current year it is positive. And financial net cash flow from financing, negative. So it is plus plus minus, plus plus minus. Companies made profits, meeting financial obligations, a part of which is also made by selling assets. What is the need, etc.? If you look into details, you'll get the idea. So whatever we are learning will help us in that. Now, this is how we read cash flow statement. Now, why I mentioned this before I completed DuPont, by the time I end DuPont, you will get the idea. Please follow. So please do this. There's a very, very interesting book. This is the title of the book. Business Valuation and Analysis Using Financial Statements. This is by Krishna Pallepu et al. Plus few other authors. Business Valuation and Analysis Using Financial Statements. Simple book, particularly anyone from commerce management background who have a basic knowledge of financial statements can very easily understand, but excellent book. Very, very interesting book. What I just mentioned about how to read cash flow statement, I picked it from this book. But how many books actually give these tricks and tricks? So simple, but we are not exposed to because we don't have right references. But please make a point. Indian editions are available. Not very expensive, I guess. Library copy, I don't think should be difficult, but it will be very useful. Business Valuation and Analysis Using Financial Statements. Okay. Right. I have given you annual report. Ask you to find that company, is it growing, has it stagnated or declining? How to find DuPont model helps us. What does it say, sir? How should we find out? According to this model, just calculate one measure. What is this measure? ROE. How to calculate? PAT by shareholders' funds. And whatever number we get for last year, current year, compare and identify, is it growing, etc. And model says this is more than enough. I raised a doubt. How can one number be enough? One ratio be good enough? You'll see. Now, any change in ROE, according to model, is either because of what, sir? Change in profitability, change in efficiency, or change in risk. So ROE is a product of profitability, efficiency, risk. So first, profitability. How to measure it we saw. How to decompose it and find, is it because of tax, because of interest? But more importantly, it is because of change in operating profits. Which item of operating profits or operating cost, material, etc. So the decomposition. This sheet, whatever I'm working, end of the day I'll send it to Dr. Usha. In turn, you will send, or I'll give you my email ID. Please mail me. I'll send these sheets. You can use it for display as well. Now, this is one factor, one reason why there could be change in ROE. Next one is very interesting. One more reason for change in ROE is efficiency of what? Efficiency of resources or efficiency of our assets. So how efficiently assets are put to use will also have an impact on ROE. Now, how did we measure profitability, sir? PAT by revenues. Now, how to measure efficiency? Very simple. Revenues or turnover divided by revenues by total assets. Revenues by total assets. Now, what is this ratio called as? All these are ratios. Asset turnover ratio, total asset turnover ratio. So same, all these ratios we are aware of. You learnt it, but just putting it in one place. So this is efficiency. Okay. Where do we get revenues? Income statement. Total assets? And both are directly available. Just pick them, put them, calculate. Now, let's say last year I got this as 10. When I calculate asset turnover ratio for last year, I got 10 as the number. How to read this? Times, okay. But there's a simpler way to read. How to read asset turnover ratio? Very simple. Last year, every 1 rupee of asset generated a revenue of times, no doubt, but that's how we read it. So last year, 1 rupee of asset generated revenue of 10 rupees. Well, let us say this year it is 9. This year it is 9. So this year, same 1 rupee of asset is generating a revenue of 9 rupees. What can we say? There's a decline in the efficiency. When the productivity has reduced, 10 rupees has generated 9 rupees, there's a decline in efficiency, we say. Fine. But why is there a decline in efficiency? So for this, we need to decompose this ratio also. What does total assets include? Non-current, current, fixed assets. So what can I do, sir? Revenues by net fixed assets. Revenues by current assets. So to decompose efficiency, this is what we do. Revenues by fixed assets, revenues by current assets. What is net fixed assets? After depreciation. Okay. Now, I want you to carefully think and tell me. I take revenues, I take net fixed assets, non-current assets, but be careful. When I say non-current assets, we don't take everything. Everything is not fixed assets. So these are assets, non-current. What all do you think I should consider here? Property, plant and equipment. These are the what we call productive assets. Capital work in progress, we can consider because even that would become. Even intangible assets. That's all. What are financial assets? What we have invested in elsewhere, not to consider. Even this capital work in progress, intangible assets and development also, we don't have to consider. Consider only property, plant and equipment and intangible assets. Okay. Now let's say last year, again, this was 12. This year, 10. What's your interpretation? How to read this? We know last year, 1 rupee of fixed asset generated a revenue of this year 10 rupees. What was the interpretation? What's your inference? Is a decline in efficiency of fixed assets will not be correct. Because fixed assets, we can't blame everything for. Now, let's say last year demand was less, production was less, revenues was less. How is fixed asset connected to that? How has fixed asset contributed to that? Last year, the short supply of raw material. So, the production was less, sales was less, revenue was less. Can we blame fixed assets for that? No. So, even though we calculate fixed asset turnover ratio, this is fixed asset turnover ratio, we don't take this seriously. Just ignore it. Number you can have some meaning, but we generally ignore it. But what is very, 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 very important is the next one. And again, many companies have failed and gone bankrupt just because this item. So I take revenues, I take current assets, again, other than investments included in it. So let's say last year I got 8, this year 6. How to read we know. Last year, every 1 rupee of asset generated a revenue of, every 1 rupee of current asset generated a revenue of 8 rupees. This year, 6 rupees. Now, this year, let it be even 7.8. We feel it's very close, but very serious. Some problem with managing current assets. Some issue is there. And if you don't identify now, this itself can become big issue and anything can happen to business. So efficiency is another factor. First we calculate total asset turnover and decompose, but fixed asset turnover, ignore. Current asset turnover, very serious concern. Now how to decompose this, how to find out which current asset? What does current assets include, sir? What does current asset include? Cash, but more importantly, inventory, receivables. So what we do, we calculate inventory turnover ratio receivables turnover ratio. Receivables turnover ratio. How to calculate formula? I presume we know. Let's say last time it was 6, this time it was 4. Last time inventory turnover ratio was 6. What does it mean? How to read it, sir? 6 times the inventory was replenished. Or in other words, how many months in a year? 12 months by 6, 2 months. So inventory was in stock. We had stock of inventory for 2 months. Okay, we can't interpret. But this year, we have inventory with us for how many months? 3 months. And what is in inventory, mind you, is debt funds, correct? So our funds are held up for a longer period. On those funds, remember, we pay cost, interest, but it is locked up. The earlier, the faster the replenishment, it's ideal, it's healthy. Longer the replenishment, longer the turnover time, something is fishy, something is not good. So there is some problem with inventory, there's a decline. Even let it be 6.6. Be careful. If it is declined, some concern. It has increased, something is managed efficiently. What is it? Now, what does inventory include? Inventory management, you would have learned, discussed. What does inventory management include, sir? Procurement management, stores, issues. Somewhere there is some issue. All this we learned in costing somewhere, correct? But no distinction, no borders. Everything is, end of it, business related. So some issue, either with procurement, something about storage, something about issue. Something would have happened. What is for us to probe? But we know stores or inventory, there is some concern. That is the key. Okay. Sir? Valuation. Now we have accounting standards, so we don't have any controversy there. Which accounting standard tells us about inventory valuation? Ind AS 2. So we have, and it's mandatory, we have to go with it. So there we may not be able to play much, but possible also. Okay. Let's say receivables turnover ratio. Average credit sales by average receivables, etc. We calculate. Last year it was 8. What does it mean, sir? 12 months divided by 8. Last year, the credit period was 1.5 months, meaning our funds was with our customers for 1.5 months. This year, 2 months. There is increase in credit period, due to which funds what we get is late. So we should maintain high working capital, for which we should end up paying high cost. Why the credit period increased? You should probe. So all this is what we call as receivables management, what we learn. And calculate each of these ratios. We identify the concern areas. But what is a concern? What is the problem there? We need more insider information. But from annual report, at least how much you can find out. So if we keep doing this, we get to what extent this has contributed to change in ROE. Is it receivables, problem with receivables, inventory, which item? Specifically, you can identify. The Triveni engineering case, what I was mentioning, I told you, material and inventory, they had a major mess. Particularly procurement, wrong billing, wrong deliveries. What was not delivered was shown as delivered. No stores, but bills are there. You know, all this, what can happen. But all that could be identified just because the ratios indicated unhealthy scenario. So this is the second element, second component of ROE. So ROE is a product of what all? Profitability, efficiency. Efficiency is all about usage of assets. This one, again, another exciting number. So firstly tell me, what is the meaning of the word risk? When we already have the word uncertainty, why do we need another word risk? Exactly. So uncertainty when measured becomes risk. Chance when measured becomes probability. So difference is very thin, but when we measure it, when you quantify it, is called risk. Okay. The third component, due to which there can be change in ROE, is risk. Now, what risk? Financial risk. So when I say risk, there are many risks a business has, but what risk contributes to change in ROE is financial risk. What do we understand, sir, when I say financial risk? Sorry? Okay, how we measure it? Okay. But when do we say there is financial risk? When we borrow. Whenever we borrow, we say there is a financial risk. Why? When we borrow, we have to pay return periodically. And for this borrowing, there is always a security. Now, if you don't meet our obligation, interest obligation or installment obligation, what can happen, sir? The assets can be confiscated, business itself can come to an end. So, by the way we funded the business, there is a risk involved that is called financing risk. Fine. But firstly, is it good to borrow? When there is a risk, why should we borrow? As an individual, we say better don't borrow. But as a business, better you borrow. So, how? I'll give a small example. Please observe here. Kept all this ready. Let's say you want to commence a business which calls for a capital of, let's say, 20 lakhs. So you want to commence a business. You need 20 lakh to start the business. Friends, ROI for this business is 20%. ROI. What we are discussing is ROE. This is ROI. What is the difference, sir? So ROI is nothing but EBIT on total capital employed. Correct? ROE is on shareholders' funds was the return. This is on total funds was the return. So EBIT by total capital employed. Now, what's the total capital we need? So ROI 20% means EBIT is 20% of capital. So 20% of 20 lakh is how much, sir? 4 lakhs. So if you start this business, you can expect an EBIT of 4 lakhs on an investment of 20 lakh every year. But then question is, how should I get this 20 lakhs? What should be the source? Let's take two alternatives. One alternative, we get entire 20 lakhs by issue of shares, only that. Only issue of shares, no other alternative. Alternatively, I raise So let's say these are the two alternatives. End of the year, 4 lakh is the EBIT, which is 20% on capital, less interest on borrowings. First alternative, we don't have any borrowings, so not to worry. Second alternative, 10 lakh in the form of 12% debentures, 1 lakh 20,000. So our earnings before tax is 4 lakh in the first case, 2 lakh 80,000 in the second case. Now, let's say tax is 30%. Presently, tax rate is 25%. For most of the companies, only few it is still 30%, correct? So now on, generally it is always better to say tax rate 25%. Okay, I've just taken 30, I'll mention the same. So 30% tax. So what is earnings after tax? 2 lakh 80,000 in the first case, 1 lakh 96,000 in the second alternative. We know from profits after tax, in case of preference shares, first we pay them the dividends, only the remaining belongs to equity shareholders. So first alternative was the preference shares, we don't have any, so 0. Here, 16% preferential 6 lakh. So on this 6 lakh, 16%, 96,000. So earnings after tax minus this will give us what is called net income. What's the meaning of net income? Profits available to equity shareholders. Now, both alternatives we calculated. Now, let's calculate ROE. What's the formula for ROE? PAT or net income. Because there's preferentials, we should take profits available to equity shareholders. So, this is the net income. The first case, share capital is 20 lakhs. Second case, this is a net income. Share capital is only 4 lakhs. This is return on equity. Now, in the first alternative, where entire capital was mobilized only by issue of shares, what happened? The return shareholders get is much less than the return the business gets. 20% is the return the business generates. Shareholders get only 14%. But in the second case, can you see? Business earns 20%, but we are able to leverage the effect of debt, due to which 25%. So, having debt is always advantageous to shareholders. So, that's what you say. Higher the risk. So, the more financial risk we take, better return, but we can't take any unlimited. There's always ways to curtail it, but higher the risk, higher the return. Now, this is the connection between risk and return. So, when I say risk, this one more component which has an effect on ROE. But now, how to measure this? How did you measure profitability? PAT by revenues. How do you measure efficiency? Revenue by total assets. Now, please follow this carefully. Now, I'll give you a ratio. Please tell me what you understand from this. Shareholders' funds divided by total assets into 100. How do we read this? Okay, correct. Let's say asset is 60%. What does it mean? 60% of assets are funded by owners' funds. What are the assets in the basis? 60% is funded by owners, which means remaining 40% funded by outsiders. Now, let's say last year this number was 60-40. Current year, let us say. Last year, let us say it was 70-30. 70-30. Now, this is the ratio I'm calculating. So, last year, out of total assets, 70% was funded by shareholders, meaning 30% is by borrowing. This year, 60% of the assets is funded by owners, which means 40% is funded by outsiders. As the risk increase or decrease? Increase. Because last year, borrowing was only 30% of assets, this year it is 40%. But actually, the number what we should see is this. This complement, how to read I know, but this is what we should see. What is the number? How much of assets is funded by owners? A decrease in this indicates what? If this number decreases, what does it mean? Borrowing is more, risk is more. So, if this number decreases, it indicates high risk. If this number increases, what does it mean? Low risk. Now, this is how we measure risk. But there's a small confusion. If this number increases, it means less risk. Decreases, it means high risk. So, to avoid this confusion, what we do normally, instead of taking this way, we just inverse it. What is the inverse? What's the inverse of this? Total assets by shareholders' funds. Friends, that is how we measure total assets by shareholders' funds. And as a friend rightly said, this is what we call as proprietary ratio. This is the proprietary ratio, which is nothing but inverse of value. Now, because of inverse, what happens, friends? If this number increases, it means there is high risk. If this number decreases, it means there is low risk. Originally, this is the formula for measuring risk. This is the formula for measuring risk. But was there confusion with this? Was a problem with this? If this number is increasing, it means risk is decreasing. If this number is decreasing, it means risk is increasing. So to avoid the confusion, instead of taking shareholders' funds by total assets, we take it as total assets by shareholders' funds. What's the advantage? Then, when it's calculated, any increase indicates high risk. Any decrease indicates low risk. Now comes the beauty part. Now, any change in ROE is either because of what, sir? Profitability or efficiency or risk. Now, can you multiply all these three and see what happens? Add by revenue, revenues by total assets by shareholders' funds. What do we get, sir? Add by shareholders' funds. Nothing but what? ROE. Please see how beautifully everything here gets captured into one ratio. What all has been captured? Observe now, friends. Everything about profitability, whatever we calculated, is relating to what? Income statement. Correct? Whatever we analyze about profitability is all found where? In income statement. How about efficiency? Relates to assets. Risk means what? Financing, which we find where? Entire financial statements, friends, is captured in ROE. Correct? Whatever we have in income statement, asset side, liability side, is now getting synergized, getting converged into one number, one ratio called ROE. You see how beautifully the model has been designed to bring relation between them. All these ratios we are learning independently. We know, I told you nothing new, but first time we are seeing everything getting integrated, and unless it is integrated, we may not find it effective to interpret. So, when I asked you initially, how can one ratio, ROE, tell us the direction? Because ROE is not one number, it is a convergence of everything in financial statements. Income statement, assets, liabilities, whatever happens, will get depicted in ROE, one number. See, that if you say check the direction, we know, is it growing, stagnated, declining. So, in simple words, DuPont model tells what are the problem areas in the business, how to identify it. The problem areas could be where either it may be some item relating to what? Income statement, or something under assets, or something under liabilities. But it will point out which are the areas of concern. Now, as outsiders, we may not have much information, but the area of concern, if identified, then with some more insider information, we can identify the problem and even find a solution. Please remember, whatever we learn and teach in commerce subjects, management subjects, are tools and techniques for solving problems. Anything to take. Only problem is we don't know how to identify the problem. Given a problem, how to solve, we know. Our students are also experts. How to identify the problem. That's where this comes into picture. But what is even interesting? DuPont tells us what are the concern areas, what needs management. So what needs management? Some item in income statement, some item in under assets, some item under liabilities. Now, how well have we managed it? How well have we managed it? What to manage? DuPont tells us. And what to manage? It is either something about income statement or something about asset, something about liability, or combination. Now, how well have we managed it? We can find out in cash flow statement. Cash flow statement has net cash flow from what? Operating activities, which is relating to what, sir? Income statement. Next, investing activities relating to what? Financing activities relating to what? Now, can you see the connection? So while this model tells what to manage, cash flow statement tells how effectively it has been managed. How to read cash flow statement. Of course, we need to further analyze it. There are furthermore connections for which we need some knowledge on valuation, etc. But this is DuPont model, very, very important. Very common exercise assignment given to students. So Professor Sandesh from college in Bangalore, MLA College, Bangalore, and he is well known to give very practical assignments. One compulsory assignment he always gives is on DuPont. So annual reports are given. Now how deep you can go? Okay, it can vary, it doesn't matter. At least the first line, this portion, and if possible, even this much. If you are able to make students identify, that's a good beginning. Please imagine the kind of depth that they're able to get, and even if they get familiar with annual report, financial statement, calculate 2-3 ratios, it is much better than just discussing some problems in the classroom. And not a rocket science, any of us can do, and making students is not a big difficulty. Now, I have one exercise here, but I don't have much time for this, and it's all about calculating ratios. Calculating ratios with the information. You know the formula. Time permits, and then we'll do it. But simple formula, so nothing extraordinary. So ROE, how to calculate? What's the formula, sir? PAT-based shareholders fund. So in the statements, identify PAT, identify shareholders funds, divide, you get this. So same way, profitability, efficiency, risk, how to calculate. You see. So I'll pass on this. Please try some. This is one of the models we wanted to discuss today. DuPont. Its utility will not stop. So many areas in financial management, we make a reference to DuPont. So make a beginning and please make our students do one exercise on this at least. We'll see how much of practical knowledge they have. How many of us are into investing? We invest in what, sir? Mutual funds. Of course, our women here, I know they don't say, but I know what they invest in: jewelry, gold, etc., etc. I know you don't have to tell. It's okay. You can be confident. We won't inform income tax department, but fine. But whenever we say investment, mainly what comes to mind actually? Which asset comes to mind? Stocks. Of course, lot of avenues available, and once an investor is willing to take risk, then certainly would like to invest in stocks. But one big challenge is which stocks are good for investing. So this afternoon we had a discussion with one of our friends, and of course this is a common concern, and most of the time we depend upon investment advisors' advice, and not all the time it may work for simple reason. And these investment advisors who also are investors, when they want to buy, they ask us to sell, and they want to sell, they ask us to buy. So for them it's beneficial. But as an investor, I should have at least a foundation knowledge, basic knowledge, which stocks are good for investing. How? For those of us who are into commerce and management, it's a cakewalk, it's a child's play, very simple. So very good criteria available. I'll show you 3 such criteria. But before I get into that, I'll connect to internet. I'm taking to a website. This is one such website. There are many websites like this available, but what I'm showing is a website called valueresearchonline.com. Those who teach finance, investments, etc. This is a very useful website to show in the classroom to give more practical knowledge rather than just something in the classroom. Now, this website lot of information. But gives you, firstly, if you want to invest in mutual funds, how to select which is the best mutual fund. Very easily provides a framework, some windows. If you just go with it, you can do. But I'm not getting into that. I'm getting into stock. Let's say I want to invest in stocks. Second. Let's say I want to invest in stocks. How to know which is the best stock? There are many details available here. But just to show you, friends, BSE Sensex, have you heard of? You know, how many stocks are there in Sensex? 30. Now, we heard of BSE 500, another index, which is calculated using 500 stocks. I'm just selecting BSE 500. So out of BSE 500, which stocks are good? I want to know. Friends, there's one item here called filter. Filter, clicking that. Something called essential checks, click that. Can you see what do we find here? Altman, Z score, Petrovsky, F score, modified C score. Some of the standard parameters to decide which investments are good. Now, we should be discussing this. We'll discuss it today. Simple, very simple. Each of these take 10-15 minutes. I'm just clicking this. Some numbers are coming. I'll tell you that. We'll explain, discuss that. So just click this. By default, something came, more than, something has come. What is it? Let's see. Apply. Friends, I get a big list. All this is a list of out of BSE 500. That is a sense index made out of 500 stocks. Which all stocks are good for investment? And I selected this using 3 criteria, 3 parameters called Altman Z score, Petrovsky F score, modified C score. What is it? We'll see. And please make a note of these stocks, a couple of them, some 2-3 of them, whatever you are able to see on the screen. Follow these stocks for next couple of months. Just follow. 90% of the time, these are the stocks which can give you good returns. Nothing is 100% accurate. We know that. Nothing can give us perfect results. But 90% of the time, you can see good returns. But what are these 3 criteria? Is stock selection so simple, friends? Yes, very much. So what are these 3 criteria? Let us see one by one. So first I'll take you to, so this is valueresearchonline.com. That's where I went. You can do that. And like this, there are many websites. This is not just one of them. Morningstar.in, etc. Many websites, all similar. They provide you such similar this thing. While you research online, the approach is easy. I showed you this, but go for any other websites, you get similar information. Okay. Now, I'll start with a simple one first before we take a break for tea, called Petrosky F score. And this is Joseph Petrosky. Joseph Petrosky, an American professor, wrote an article in year 2000, Value Investing, that's the name of title of his article, use of historical financial statement information to separate winners from losers. So which stocks are winning stocks, which stocks are losing stocks. To separate them, he came up with this model, and this is the title of the article in which he mentioned this. Trust me, so simple, so simple. Financial statements where you find, annual report we know, keep them. And he gives 9 parameters, 9 criteria, 9 criteria Each of these, let us read. If whatever mentioned there is fulfilled, is taken care of, is addressed, we give 1 point. If the criteria is not fulfilled, we give 0 point. How many criteria I said we have? So, what's the maximum score we can have? 9. What's the least? 0. And a stock for which this is 8 or 9 or above 7, if you have, these are very good stock for investment. And 90% of the time, it has been proved correct. I told you, every model, please remember, 100% nothing can be accurate. If so, then nothing else is required. I can just choose the model, keep making money. Never ever anything can be completely 100% correct. 90% has given results. Now, what are these? Now, first I'll show you the financial statements. These are just made up figures. Same financial statement format. Revenue from operation, cost of goods sold, gross profit. Same format we know. I've taken that. And current year, last year, share capital, other equity, etc. Then we also have one more information. Okay, we'll see what we need. Now, same financial statement, I just put figures. Earlier I just gave a blank format. I put some figures here now for current year, last year. Now, what is this criteria? First criteria says, in the current year, the net income should be positive. Means, net income means what, sir? Profits. Positive means profits. Negative means loss. Now, is it so? Net income, profits after tax, net income. Is it positive? Yes. Current year. This is current year. So, what should be the score for this? 1. As simple as this. Second, positive return on assets in the current year. Now, what is return on assets? How do we calculate return on assets? So, we had, if you remember, ROE, which we discussed. ROI, we discussed. This is ROA. All are different. How did we calculate ROE, sir? PAT by shareholders' funds. About ROI? EBIT divided by total capital employed. ROA is similar. It is EBIT by total assets. And what's the difference between total capital employed and total assets? Total capital employed will always take only long-term capital, correct? Total assets? Total assets. So, it's not the same. So, what's the second criteria? ROA should be positive. I don't have to even calculate. How do you calculate ROA? EBIT by total assets. If EBIT is positive, automatically ROA will be positive. So, in this example, is EBIT positive? Yes. So, 1. positive operating cash flow in the current year. Now, where can I get operating cash flow? One, you can calculate net profit plus depreciation, or directly you can take it from cash flow statement. Cash flow statement, operating cash flow. Now, in this, the simplest way to calculate, as I said, earnings after tax plus depreciation. Is it positive? Yes. But this is important. Operating cash flows are greater than net income. Operating cash flows are greater than net income. Now, suppose this is loss, or I'll just show you. When this is Reliance Industries Limited, I'll later open the annual report for you. And I've taken this information from cash flow statement. What's the cash flow from operations, you see, friends? Minus. Net income, 31,944. Cash flow from operation, negative 512. Now, what is the condition required? Operating cash flow should be greater than net income. Is that the case? No. So, but in the case what we're discussing, the cash inflow is greater than net income. So, we give 1 point. Then, long-term debt in the current year, lower long-term debt in current year compared to previous year. Again, first I'm showing you Reliance long-term debt. This is current year, last year. Please see. Last year, what was the long-term debt? 197,332. Current year, 164,612. Now, what is the criteria? Lower it is. But that was for Reliance, I showed you. Here, non-current liabilities. Last year, 3 lakh. Current year, 4 lakh. So, in this example, what I'm showing, it is not lower. In fact, it is higher. So, 0. Higher current ratio in the current year compared to previous year. How do you calculate current ratio, sir? Current assets by current liabilities. So, we have current assets here. Current liabilities divide, already calculated current ratio. So, compared to this last year, this year, the current ratio should be high. That's what it says. But when I calculate, this is for last year 4, this is for current year 3. What is the scenario? Lower. Then, no new issue of shares during the year. So, statement of changes in equity will give us that. And here, if you see in this example, last year, what was the share capital? 4,50,000. This year, 4,50,000. Any change? No. When do we say there is a issue of shares? When this year it has increased. So, no new issue, correct? Higher gross margin in the current year than compared to previous year. What is gross margin, sir? Gross profit as a percentage on sales. We know where to get gross profits. Sales, when I divide, I get gross profit margin for last year, current year. What does the condition say? Current year, the gross margin should be higher than last year, but here it is exactly opposite. So, what is that? I put 0. Then, higher asset turnover in the current year compared to previous year. How do we get asset turnover ratio? Revenues by total assets. So, when I calculate that, revenues by total assets, so done already. Asset turnover, these are revenues. This is revenue. Total assets, get 1.2, 1.25. Current year, it is less than last year. So, what should I say? 0. Simple. Now, in this example, what I have given was the score we got 5. But normally, market practice is it is above 7, 8 or 9, it is good stock for investment. If not, better avoid. But don't judge based on only this. There are other 2 criteria, Altman Z score, modified C score. Use that. When all the 3 are fulfilled, better. And whatever the stocks we got under valueresearchonline.com, what I showed you, all those are those which fulfill those criteria. Let's take you through again. filter, essential checks. Now, when I say Altman Z score, Petrovsky F score, by default it's asking 7, but if you want, you can even fix it. More than 7, more than 6, more than 8, whatever you want, you can fix it. It will select only those stocks. So let's say fix it as more than 8. Then only stocks which has 9 as Petrovsky F score will get selected. And if the other two are also favorable, truly a good stock for investment. But forget about investment, etc. That's not point. But what I wanted to show you is a model. You chooses financial statements, analyzes it, and identifies is a stock good for investment. So this is one more model for analyzing financial statements, but purpose is limited for those who want to invest. So this is one such other model, Petrovsky F score, very popular. Now, but only limitation is, if you select stocks using this, only for short term, that is medium term investment, it's good, 1 year, 2 years. If you want to go for very long term investment, very long term, then we go for many other models available. So just to show, those who can see, 1 second, let's get magnifier. Can you see? Peter Lynch stocks. There is one more. Joel Greenblatt. All these are some models. All these are some models which helps in identifying which stocks are good for long-term investment. And for most of this also, information is what you can get from financial statements. And one such very popular model is Benjamin Graham's model, or called Graham-Rao model. Graham-Rao model. Benjamin Graham was a guru for Warren Buffett. I think Warren Buffett, being in commerce management, if you don't know his name, as good as we don't know Abdul Kalam was our president. So popular. Comes to investment, he is the top class. Benjamin Graham was his guru. A model which he designed and Indianized by one Professor Rao is Graham-Rao model. So we have many such models to select stocks for long term. But that is cannot be captured like how we did for Petrovsky F score, but those models exist. But this is Petrovsky F score is such a popular model, and please ask investment advisors. When websites show that, it means it has some practical relevance. So this is one more model to read, to analyze financial statement, but if the purpose is to invest in stocks. Limited usage, but still a model for reading financial statements. And what time are we taking break? Oh, fine. Then, friends, all of us know about Satyam. Today, it's not there. It has become Tech Mahindra after acquired by Mahindra Group. In 2010, the scam came out, and world got to know what all problem has happened in Satyam, and it went to the brink. It was acquired. Today, it exists in a different manner. Friends, 2008, I had given one assignment to my students, each different groups, on what is called Altman's Z score. Altman's Z score, simple model, very simple, but again, very, very powerful model. Altman's Z score. This score actually, if you calculate it, it tells us in the next 2 years, is there a possibility for this company to go bankrupt? The next 2 years, is there any possibility for this company to go bankrupt? Is what this Altman's Z score can tell us. How? I'll show you. Friends, I gave this assignment to our students. Every group worked on one company. One group took Satyam and calculated this. Z score, and according to them, next 2 years Satyam will go bankrupt. That was the message. But friends, at that point of time, Satyam was a very big company. Just a few months back, it had got a Golden Peacock Award. Golden Peacock Award is an award for best corporate governance. She got that award. We all laughed out, said, okay, some mistake. It can't be the case. Satyam, how can it go bankrupt? But friends, 2 years later, it happened. So this model was not faulty, though not all the time it may work. The accuracy of this model is 75%, it says. Still excellent. Enron Corporation. Again, we know another company known for its scams, scandals, and in accounting, always we discuss that as a case because classic case of accounting mismanagement and accounting fraud. A study, if you just do Google search, you will get to see students of New York University in 1996 or some year, they applied Z-score to that Enron and they said it will go bankrupt in next 2 years because the model said so, but market didn't believe it. At the time, the student said one share of Enron was $48, but still people didn't take serious. They went on buying. 2 years later, one share price of Enron was $96, but that's when it went bust and went bankrupt. Doesn't exist today. But they also identified by applying this model that it can go bankrupt in next 2 years. Very effective, but very simple model. Very simple. And this model, Altman, David Altman, I think so is the full name, and the professor, Edward Altman. Initially, he came up with this model for public manufacturing companies in USA. Public limited companies manufacturing in US. Later, he also came up for private companies, a small change. Then, why only US? Developed economy. He also came up with a model for emerging countries like India, how to find any company, will it go bankrupt in next 2 years or not? Now, what I'm showing you is such model. Again, very simple. We just calculate some ratios and there's a mechanism to read. If you do so, you can identify, can a company, is there a possibility for a company to go bankrupt in next 2 years? And Satyam, when Ramling Raju wrote the letter saying that all this has happened in Satyam, I apologize to shareholders and the public. Please go to Google search, letter by Ramling Raju to shareholders, a 4-page letter he wrote explaining what all happened. Next day, newspaper came up with a very beautiful headline. Friends, today we have vertical balance sheet, correct? At that time, it was horizontal balance sheet. What was on the left side? Liabilities. What was on the right side? Headline in the newspaper was, in Satyam, there's nothing right on the left side, nothing left on the right side. Please think on the statement, you get to see how meaningful it is. Left side, nothing is right. Right side, nothing is left. No set is left. How beautiful. But that sums up what exactly happened in Satyam. Now, how to measure this Z-score? Friends, all of us know research. Most of us are doing research. Friends, how do we analyze data, research data? There are broadly 3 types of analysis what we do in research. Why this background I'll tell you. So there's something called descriptive analysis, inferential analysis, and predictive analysis. So any research, this is what we do. Descriptive, inferential, predictive. Now, what is this predictive analysis? This predictive analysis is all about building models. Building models for prediction. So to build model for prediction, and this can be done with the help of something called econometrics. And those into research, please get used to all this. particularly accounting and finance research, is meaningful only when you can build models. So, how and what is this econometrics? I didn't have much time, otherwise I thought I'll just make some data and show one package called Gretel. It's a simple package, a free package it is, open source package called Gretel. Click of a button, you can build model. Just you need the right data. So this is a model which is built using that econometrics. And model building is all about regression. Now, can you tell me what is regression? What is regression? With the help of one variable, we can predict the other variable. So when I say y is equal to a plus bx, what does it mean, sir? Given x, how much is y? So let's say x is advertising budget, y is sales, correct? That's a standard example we take. But here, we have only one variable. Now, let's say y is equal to a plus b1 x1, b1 x1 plus b2 x2 plus b3 x3, etc. We call it as multivariate model. What do you understand by multivariate? Different variables. So y is influenced by many variables. It's called multivariate models. Friends, what Altman built was such a multivariate model. Friends, he gave 5 variables with some weights. These weights, what are given is this b1, b2. b1, b2, b3 is this weights. And if I calculate the ratio, some ratio is given. What are these ratios? Let's see. Multiply with the weight, I get a score called z-score. So weighted average. So value into weight. Now, how to calculate? So this is standard. How we got the weights? As I said, through econometric modeling. How to do this modeling? His data, whatever data if he has, we can run through Excel, run through Gretel, and we can get the same. But obviously that data we can't access. But similar data if we can create, we can get our own model. But his model he tested, found it accurate 76% of the times. So that is what is popular. But we can create our own such models with similar data. Now, what are these? Friends, first ratio says, take working capital by total assets. How do you get working capital? Current assets minus current liability by total assets. So out of a total assets, how much is liquid funds? So this is called as measure of liquidity. How to calculate? So the same example what I showed you, what I gave earlier, I've taken the same example here. So how do we calculate working capital? Current assets. So in this 3 lakh, in which this 3 lakh includes inventory receivable so much, minus current liabilities 1 lakh, divided by total assets 10 lakh. So this is one score. So all that I've done is take working capital by total assets. So I'm just demonstrating how it is to be calculated. Okay. What's the next one? Retained earnings by total assets. What are retained earnings, sir? So how much of retained earnings are funded, are used for funding total assets? More this indicates less leverage. More of our own funds means leverage or risk is less. So this is called measure of leverage. Now, where do you get retained earnings? So retained earnings is nothing but other equity divided by total assets. Total assets. So we get a number. This number into weight will give us this number. Then EBIT by total assets, as you know, return on investments, or this is called profitability measure. So is equal to EBIT by total assets. So this is the number. I'm just calculating as per this. But this is the next one which is important. Market value of equity by book value of liabilities. Now, liabilities means non-current and current liabilities, outside liabilities. What is this market value of equity, sir? How do we get this? Market value of equity. Number of shares issued by the company into market price per share. Market price I can get for any company. So this company I just calculated. So just given some information. Number of shares, I just took 4,50,000 by 10 rupees per share, market price per share. So when I multiply this, I get market value of equity divided by book value of liabilities, means non-current liability. Seven 1976 to 1996, 20-year data you took companies. All those companies went bankrupt. It took the past data and found 76% of the time this was found effective. But it's even better, but average 76%. In different economy, results are even better. And today, any bank, many banks, in their website, they have Z-score calculator. So just go and put the data. But this is for which type of companies, sir? I said manufacturing. Now, if it is not manufacturing, all the same, working capital by total assets, retained earnings by total assets, EBIT by total assets, market value of equity by book value of liability, all the same. Which is the last one we had here? Sales by total assets is removed because assets play a role in manufacturing entities, productive. Trading entities, non-manufacturing, what assets? Furniture, etc. Will it have a big role to play? No. The non-productive assets are more. So, if felt, there's no need to incorporate that. But weights are different. Weights are different. If this were to be, same example what I gave you, were to be a non-manufacturing entity, this would have been the score, 14.29. But how to read this? Friends, the manufacturing company, these are the scores. If it's non-manufacturing, greater than 2.9, safe zone. Between 1.23 and 2.9, gray. And less than 1.23, distress. Similarly, emerging markets. Emerging markets. Similar, but there's a constant 3.25, like this regression equation. Y is equal to A plus B1 x1. A is a constant. So there is a constant that is added here. How this gets generated? Friends, that is econometrics. So that's another very interesting area. Outside the scope of discussion for today's discussion, but I would love to sometimes show how these models are actually created with some at least random data. How these models work, we can always see. Let's see, when you're doing the case study, when you're doing that, if I can try to generate some data, I'll try to show how these models are made. But that's not what we're discussing, how the models are made. And it will be good for you to know. Those who want to get into research, these are areas you can explore actually. If you can get a model better than Z-score, why not? But testing and proving it is the challenge. But if you can do, definitely possible. So this is for emerging markets. And I told you earlier was for public companies. For private firms also came up with, only difference in private firm is public companies shares are traded in the market. We can find market value of equity. Private firms, no. So he suggests take book value of liability, book value of equity by total liabilities. That's the only change. And again, how to read for each case is emerging markets. When it is safe, gray, distress. Private firms. Now, this is Z-score. And again, if you see here, stocks. Again, I'm taking BSE 500. Filters. Essential checks. Now, Altman Z-score, when I click, can you see by default what's coming? 2.99, because that's the value given by Altman to say. Above this only safe. Markets consider this seriously. But point is, friends, we can all calculate if I just know the template, and which is what I've been showing you. So you can just calculate all this, just if you have financial statements ready with you. So this is another model of analyzing financial statement. But what is the purpose of this? To identify, would a company go bankrupt? Is there a possibility for a company to go bankrupt in next 2 years? Fine. Now, modified C-score, I'll explain after we discuss Baini-Shem score. You will see this Baini-Shem score, whatever I discuss, a small part of it modified C-score, but not much relevant when compared to this. But in the market, since it is shown, I'll be discussing later. But post break, we'll discuss this. But what we'll now do is, friends, we'll circulate the first case study. I showed you the case. There are 5 balance sheets given, 5 companies given. Your job is to identify which balance sheet belongs to which company. Now we'll circulate the cases to you. During lunch break, have a networking talk, but please also discuss on the case, a group of 5 of you, your own college, your own this thing, or whomever you can, make a group of 5, discuss. Let's see how well are you able to read information in the financial statement to identify this component. So post that, we'll spend some time on the case, and then I'll discuss the last model, Baini-Shem score, and an offshoot of that is modified C-score. Ma'am, can we distribute the cases? First case you can distribute. Harvard only. That page 15, 17 we have taken the print. That one. Only the 2.